Hello, good evening, everyone who is joining us live or probably going to watch this recorded video later on. I am Puru from Find My Real Estate, and I'm the host today for this session. And I have a lovely guest today from Sydney. Actually, he's joining us, Sakib, and
Good
he's
evening.
good evening, Sakib. How are you today?
Not too bad. How are you?
I'm very well, thank you. And look, thank you so much for accepting the request to make time to come online on a short notice. I really appreciate it.
Thanks for having me.
So we basically run this session every week, and as discussed with you, we will try to discuss few things with you about how to help our viewers from perspective. How can they improve their borrowing capacity in 2025? As we can see, the global economic trends are shifting after Donald Trump, and then of course,
Mhm.
interest rates are predicted this year. So I would love to get your views on that as well.
Yeah.
But before that, I would love to know a bit more about you, about your journey as a owner, founder, CEO of Secure Finance. That will be very good to know.
Thank you very much. Again, thanks for having me and giving me this opportunity. Just a bit about myself. I started my self employment into financial services just about 12, 13 years ago.
Okay.
Started My last job was with American Express as an account development executive. Spent 7 years over there. Loved every moment of it. Learned a lot from being an American company. So once I started on my own, took the plunge. I started into financial advice side of things.
Wow.
I worked there for a couple of years. I am a qualified financial advisor, and that's how I started. But those were the times a lot of compliance and the regulations were changing, and I believe Australian property market was rising from the ashes. That is post GFC time, and you could
Yep, I
see
remember that.
2012, 2013, the valuation being stuck at the same place for many many years slowly started moving upwards, and you could have a sense and a feel that people want more than what they have. And that's when I saw the opportunity and started added mortgage broking into my offerings. And that was the master stroke because it just took off like crazy, uh,
Yep.
to a point actually that I was doing 80% of my work as a mortgage broker than a financial advisor. And I loved every bit of that because the cycle for that, where you see people come with their aspirations, objectives, to the time where you get them a pre-approval and they finalize it properly and settle, it could all happen within a few weeks, and you could see the life changes that they experience from being someone who has never made such a big decision. All of a sudden, now they're owning $1 million house. So that whole shift from one to the other, just I loved every bit of it, and that's when I realized that maybe this is where my heart is. So I restricted my financial advice to the insurance, the risk part, where I was looking after the personal insurances of the client, but I was predominantly doing mortgage broking from 2014 onwards. So 2025 is the 11th year since I've been a mortgage broker. I am a
Mm.
principal mortgage broker now. I've got my own Australian credit license. I mentor brokers. I've mentored a great number of brokers in the market as well. Now I've got a team of brokers that I mentor and manage. And
Yep.
from Secure Finance has, gone on from settling 20 million in the first year to
Wow.
lodging over 200 million in the last year that we have just finished. So I couldn't be any prouder,
Well
and
done.
it went really fast. Learned a lot, made some new friends, actually made clients for life, because that used to be my mantra that I see my clients as growth partners. So they grow, we grow. So that's how it goes. And we have seen a big shift from when clients would have come to us at an early stage of their financial career. Fast
Mm.
forward 5+ years, and now they've are sophisticated, investor clients with multiple properties, probably property into a super fund. So yeah,
Yep.
it's been really, really lovely ride for me.
Excellent. This is so motivation and inspiring to listen to the journey of individuals, and I'm quite privileged to be on this call with you, uh,
Thank you.
because assuming you're a migrant like me at some point, which you mentioned to me earlier in the morning, 2000, so right on the time before Olympics. So you have
Yep.
seen fair bit of your life here. So
Yes.
the journey of coming as a migrant and then settling in here and making a career, and also the blend of a lot of academic experience and professional experience which you bring, converts
Yes.
into so much value for your clients. It's amazing, and it's a reminder for me as well. I mean, never stop learning, never stop, the hunger of improving yourself from whatever you are as a
True.
version
That's
earlier.
true. That's correct. So I always used to say to the people who wanted to get into financial services as a career, especially becoming a broker, because when the markets are good and people think it's easy to be a broker and make money. So I used to tell
Yep.
them, yes, the easiest way for you the easiest entry to a career is become a mortgage broker. That's what 100% of the people can do. But I can guarantee you, 90% of those can't survive through the first 2 years. So the harder part
And,
comes afterwards. That's where you're having the right academic qualification, not just the diploma in mortgage broking, which hardly teaches you anything, to be honest, but
yep.
like a degree or some sort of a background in financial services and
Yep.
enough experience working in financial services industry under your belt. That's where your learning is, because that's where you get to learn how to treat your clients, how to service them, how to make sure that they're happy with you, that they will stick around, so
Yep.
retention won't be an issue. And also they're
Yep.
happy enough with you that they will actually bring more business to you. Either it's your own business, their own business, or they'll be
Yep.
referring so many clients to you. That's something that you can't just learn by doing a diploma in mortgage broking. That is something that comes from experience, having worked for some different companies. Like in my case, I would give that credit predominantly to American Express and the academic background. So I've got an MBA, I've got a Master of Management. MBA helped me understanding just the decision making specialization.
Yep.
Amex helped me with the understanding of financial services as an industry. Master of
Yep.
Management helped me with managing the growth of my business. Went
Yep.
from being a one broker person to eventually having a team of over 12 people, how to manage them, how to look after their needs. Because if they are happy, your clients are happy.
Excellent. And I mean, of course, the platform is I Love Property. So, do you love property, Sakib? What has been your journey yourself? We have seen Sydney from that time, 20, 25 years now. Of course, from a property perspective, how do you see uh, different people who have helped Sydney grow in areas which were basically sticks earlier? And of course, from a financial perspective, a lot of gains people have achieved out of those investments as well.
True. So I love property, not just for
Mm.
the sake of a logo, to be honest, but I
Yeah,
have been an avid and sophisticated investor for past 14, 15 years. I have
great.
had properties off the plan. I had off the plan lands. I have um, commercial. I have had
Yep.
residential. I have built. I have added
Yep.
grannies. I've done subdivisions. So I understand the entire
Wow.
value add chain. And and at any point
Yep.
in time, I'm actually a qualified builder as well. I used to build for other clients for a good 3, 4 years. I built around 25 homes, but then that was a time
Mm.
came in 2022 when it was just too much on my plate. So I decided to stop building for other people. So now, out of
Yeah.
passion, I still build for myself. So at any given point in time, I would have at
Yeah.
least 2 to 3 projects where
Projects
I'm
going on.
building of some sort. It could be knockdown
Okay.
rebuild. It could be adding granny. It could be adding something else to it. But in
Yeah.
general, I have a bias towards property. I would be honest.
Yeah.
I personally believe Australian market being too far away from European or North American market asset classes other
Yeah.
than property asset classes. I personally believe, plus don't take that as a financial advice, just as a personal bias, I believe asset classes in Australia are not as mature or as developed as they are in Europe or North America. So the
Yeah.
only asset class that I can see that has flourished last 50 to 70 years to me is property. So I live in Bochum Hills, right? It's a Hillshire district in New South Wales. Now, Bochum Hills has increased 30 times in value since 1970s. So that makes it
Wow.
around 1.5 to 2 years, the value doubling up. So I'm yet to see any asset class that will give you that kind of doubling the value every second year. You know, plus
Yeah.
Australians loves brick and mortar. I
Mm.
know it's cliche, but that's what people can feel it, people can see it, people can touch it, and it has
Yeah.
been serving as and you probably are more expert on that side than me.
Yeah.
That I'm yet to see a time in the last 50 to plus years where the supply side has been able to catch up with the demand. So
Yes.
as long as the demand is more than the supply, it's a basic economic principle. The prices will always be strong. And that's what's the case been in Australia, as per my understanding.
Absolutely. And couldn't agree more. It's a lucky country, very young, thriving. People want to break the ceiling, as the expression goes. And
Yes.
the immigrants, of course, you would have felt the same, and I felt the same. The Australia I remember when I landed 22 years ago, and the one I see now, that itself has changed. So I'm sure the locals who are born and
Massively.
brought up here,
Massively.
they feel very differently, and
True.
for all the right reasons. So, from a topic perspective,
Yes.
we wanted to talk a little bit about this year 2025, which is well and truly in now. We are already in the Valentine's month, and
Sure. Tell me about
we
it.
want to. And one of the things which I keep getting asked by a lot of my investors
Yeah.
is about how can we maximize our borrowing power in 2025.
Okay.
And I am not an advisor. I know how other people's do it, and there is no one answer because it's a very individual circumstance based
True.
discussion and decision ultimately, right?
Yes, sure.
So I struggle to answer that always,
Yeah.
and I would like to elaborate a bit more on those aspects today, if we
Yeah.
can, please.
Yeah, sure.
Leveraging your expertise. So over to you.
Yeah, sure. Sure. See, you're right. It's not a one size fits all approach here.
Yeah,
It's case by case basis. Now, I'm going to make a general comment first.
yeah,
This is my 11th January since I started mortgage broking, right?
yeah,
That's my 11th
yeah.
year. And I've been growing every year. So it's not as if I had a bad year. This start of January has been the strongest ever in my business. And you know
Wow.
what that tells you? That
Hmm.
tells you the anticipation is there.
Yep,
Everyone at the moment there's a general vibe in the market
yep,
that we are now just about to see the interest rate drop cycle. And
yep,
as most economists are saying, when it drops, either it's next this year, this month, or a couple of months after, you're going to have
yep,
3 to 4 drops in next 12 months, and possibly a bit couple more in the next 18 months. So
yep,
as soon as a drop hits and you start feeling the impact, the market picks up uh, more than it has done last year, for example. Like it still
yep.
increased last year in Sydney, but it's gonna
Hmm.
double up easily as soon as the rate drops. So the vibe is there, and the demand is there.
Yep,
More people looking to or wanting to buy than they actually they can, and the reason is
yep,
interest rate being at the highest since November 2013. The borrowing capacities were squeezed, and there was hardly anything borrowed, because the general principle is the more the actual rate is that the banks will offer, then you add the buffer, which is at the moment roughly 3%, the
yep,
harder it's for you to borrow more. Now the first
yep,
thing when the rate drop cycle starts happens, that the
yep,
actual rates will come down, and that will ease up your
hmm,
borrowing capacity. For every
yep,
1% reduction in the interest rate,
hmm,
you are looking at around 20% increase in your borrowing capacity, just as a general rule of thumb. So imagine if interest rate drops by 1%, if
yep,
someone was able to borrow $1 million, they are able to borrow now $1.2 million or close enough. So that's a big jump. A lot of people who are sitting on the fence, they're not able to cross over. They should be able to cross over. So interest rate reduction helps. That's one way
yep,
where you see. Second, you see the markets. So yes, you have Queensland and WA, which have been on the very high end, but then you have
yep,
Melbourne. Melbourne is sitting as the rock bottom. And if you
hmm,
ask any sophisticated investor like myself,
hmm,
Melbourne is the place for someone like me to go, because that's
hmm,
where you get the bargains. Because you're not
yep,
in it for a year or two, you're in it for a long time, at least I would say 5 to 7 years. And
yep,
Melbourne, I believe, is bound to bounce once all of the markets have gone up, which probably they already have, Melbourne is now
Yes.
the sixth uh, most expensive city, when it used to be the second only 2 3 years ago, right? So which means
Yes.
it tells you that there's a lot of catch up that Melbourne would have to do once the
Yeah.
property prices start going up. So Melbourne, big opportunity. That's where even low borrowing capacity would help you get into the market, even with a five to $600,000 to get your step in the door, right? Then
Yes.
you also, so there's another big thing that a lot of brokers even don't know. There have been a
Yeah.
policy change with a couple of lenders just recently, where
Yep.
they have, so employed client generally, they will need
Yeah.
2 years financials, and a couple of lenders would need 1 year financials
Yeah.
to check their borrowing capacity.
Yep.
There have been some recent changes with few lenders where they don't even look at any of this. They say, as long as you have a company structure and you have been
Yep.
in operation for 6 months, just give us a
Yep.
6 month salary that you can evidence. We will
Yep.
annualize it, and on that
Hmm.
basis, you are able to get a loan. And that has changed the game for self-employed or someone who have moved from working for on a TFN to self-employment in last 6 months to 1 year
Yeah.
drastically. That's where we can help them. Then there are tech structures,
Hmm.
trusts. There's different types of structures that you can have
Hmm.
set up, obviously in consultation with your accountant and financial advisor. And
Yep.
there is a way we are able to, in most cases, maximize your borrowing capacity. So there are so many different ways, and the
Hmm.
lenders vary with the other lenders. So some lenders will see you favorably versus the other lenders when you have one investment property, two investment
Yep.
property. Some where your bonus is only for 1 year. Some if you're
Yep.
essential services worker. So there are so
Yep.
many variables. The best
Yep.
thing anyone can do is, who would listen to this podcast, is please come talk to someone like myself. That's what we
Yep.
do. We do day in,
Yep.
day out. Talk to us, whatever your financial circumstances are and whatever your aspirations are. On that basis, we would be able to give you, uh, a fact find and a servicing calculation based on your circumstances. And in most cases, we would be able to suggest you ways where you are able to either borrow now, or at least
Yep.
we'll put you onto the pathway where you know what
Hmm.
you need to do in next 3 months, like saving up
Yep.
a bit more for deposit, for example, or something else, where
Yep.
if not now, in 2 to 3 months time, you are able to borrow the amount that you want to borrow. I'm
Yep.
sorry if it has taken long to answer this question.
No, absolutely. We want these perspectives to come across so that people who are having these things in mind, they can consider that. And I think the most courageous thing I've always felt is to raise your hand and raise your hand on time,
Yeah,
because if you raise your hand too late, that's too late already. So
yeah.
there's no
You
shame,
were
there's
never
no
in the
harm.
game. Yeah, you were
Yeah,
never in the race.
so most of the time I was stuck. I was privileged to have someone around me to go and talk to them, and then it just gave me
Yes,
so much clarity and options. So one of the other things I've seen is uh, people get to enter into their investments, but they don't think about exiting the investments, especially those which are holding on to their opportunity costs. They might be sitting in the wrong markets, wrong type of assets which are bleeding, or even just to free up their borrowing capacities. They don't take decisions. And of course, there is a buying cost of approximately 5 to 10%, and then selling cost of 3%. So
yeah.
many times they feel that, and especially with the tsunami of support coming from the various types of buying agents across Australia.
Hmm.
So there are different type of purchases which have happened, and they don't always go with a good experience sometimes. So people tend to just sit it out, and then they feel that we will wait until the market bounces back or whatever, but they don't do that fair discussion. Again, based on their individual circumstances, their
Sure.
decision has to be made. But I personally think a good a mortgage broker is there to really help them look at all these scenarios and help them really look at, okay, if they take this decision, it will free up this much borrowing capacity that gives them an opportunity to go forward. Even things like joint venture syndicates,
Yeah.
again, it's not for everyone to do. I know there is a risk involved in partnerships, accounting cost, all the rest of it, but that's exactly where you propel.
And Superfan. Yeah, Super SMSFs.
as self-managed super funds. Here you go. That if it's not making money in the industry super funds, then go and talk to your mortgage broker. Go and talk to your accountant. Educate yourself to know what I can do better with that.
True.
So so, do you do a lot of joint venture syndicates who come to you because you're sitting in Sydney? So I'm sure people, it's a stock exchange city, so it sniffs in a very different way.
Yes. I want to start with a comment. It's more towards what you were talking about, which is spot on. But just wanted to give my two pence to it as well. See, when
Yep,
I started into the financial service industry, 14, say 2012 onwards, up
yep,
until that time, uh, more people were investing uh, by having a conventional property investment view in mind. And the
yep,
conventional view said that buy a property and hold it long enough that eventually it will give you capital growth. And
yep,
that served well to a lot of people who didn't have enough knowledge of the property. That's one thing, because
yep,
they only had to make a decision once and then just forget about it for 10, 15, 20 years. And then maybe they'll sell it when the kids are grown up. Or
yep,
that served well to the people or to the market when the cycle for the boom and bust, it used to be
yep,
a longer cycle. So if you go back
yep,
12 to 2012 backwards, say from 2000 to 2012, it might
yep,
take you 12 to 15 years to finish one cycle, you know, from
yep,
being at the rock bottom to going all the way up and then start coming down.
yep,
But post GFC, everything changed. And I have
yes,
experienced the cycles are getting shorter and shorter. So then
yep,
from 10 to 12, 15 years, it shortened to 10 to 12 years. Then we had a cycle from 2012 to 2016. So that's 4 to 5 years. Then you had
yep,
a couple of years slow. Then it picked up in
mm,
2017 until 2019. So, and then the COVID and the post COVID. So what I'm
yep,
trying to get it as is that the conventional way of setting and forgetting doesn't work anymore because the cycles are so short. So now
yep,
the new way of property investment, as per my understanding, is all about timing. It's not the time,
yep,
it's not the length of the ownership that you have of the property. It's the
yep,
time when you buy
yep,
it and when you
yep.
sell it. So when the timing is right, buy it. And when the
Spot on.
timing is right, sell it, regardless if it's been 2 years or 10 years or whatever. If timing makes it worthwhile for you and your numbers stack up, do it.
Yep,
So for example, I had done some investments, and
yep,
I was also expecting in 2022 that the rates won't start going up until 2024, right? Because that's what
yep,
the Reserve Bank was kind of conveying to everyone. So I did some
yep,
investment, and then interest rate all of a sudden started going up from May to 2022, and then within a period of 6 months to 1 year, it was from 2% to 6%. So obviously, that was something most people had not accounted for, including myself. So what I did, as soon as I realized that what the market has shifted, timing is different. Now I did crunch my numbers again, and I offloaded a lot of properties at that time. And the only reason for
yep,
me to offload was because I wanted to free up myself so I could go back
yep,
in the market and now buy when the timing was right to buy because there was a lot of bargains out there. So for me, it wasn't just just sell and run away from it. No, sell it, maybe sell for small losses, but then you
yep.
go after those new bargains. And I spent another year after just kept buying, and then putting them onto their own cycles afterwards. So as I said, it comes back to people who have the knowledge, who are the experts. So go back to them, talk to them, and see what they say at that point.
Thank you, and thank you for sharing your own examples as well, because that makes it more conviction-based response.
Yes.
So one another thing I want to talk about is commercial,
Yeah.
because there is this perceived uh, love and fear about commercial, that commercial is something you buy when you retire so you have more cash flows,
Yeah.
and the fear is right now I am better off going for residential sort of properties because the growth is more, and for the right reasons. But I think that's exactly where if you run the right strategy, you can also have some strategies to maximize your borrowing capacities.
True.
And and that's where I think I've heard in the past that a good uh, broking expert can tell you how it's all done. So if you want to share
Sure.
any of these strategies, you know.
Sure. Again, when I started into it, I bought my
Hmm.
first office with my super. I kept it
So you
for
bought your own office through a super.
yes, and that was back in
Okay.
2013. That was my first commercial purchase.
Okay.
Even at that time, the conventional wisdom was the commercial, they don't appreciate much.
Yep.
The rental yield is pretty good, which is 5%, say, in New South Wales.
Yep.
However, uh, it takes longer for them to be tenanted. Yeah.
Yes. Yes.
So that was the conventional wisdom at that time. For me, I did that out of necessity because I wanted to have an office. I said, why not? My super will buy the office and then I'll occupy, my mortgage broking company will occupy it. So for me, occupancy wasn't an issue, right?
Yeah.
Now, why I'm going to use this example is to answer all the questions that you raised. So I bought that property in 2013, and I
Yep.
sold. And then a year and a half into it, I was growing faster. Then I moved in out of this office because it was smaller. Moved into a bigger office. Then I
Yep.
got someone to rent it for another 3 years. So 4 years, I kept it, and after 4 years, I sold that office for uh, just over double the price, right? So it got
Amazing. Is it?
appreciated.
Is it?
Yep.
Yes. Sorry, I'm talking over. Is it because it's in Sydney?
Uh, Not just that. It's just that, see, it was a small office, and this was the time when the residential was going up as well. So I sold it
Okay.
around 2014, 2016. So residential had
Yeah.
picked up as well, and at that time it was a general demand everywhere. There was a lot more business. People wanted to have offices. That's a lot of professionals. They were looking for small offices. So I doubled the value when I sold the business, the office,
Here you
and I
go.
put that money back into my SMSF. So my SMSF increased in value 3 times than what the initial amount of investment was.
Mind blowing.
So, so, and I use that example even for other people that want to talk about, can we use SMSF to buy a commercial or office and all of that. So I said
Hmm.
that's what happened to me. I'm not saying it will happen to everyone as well. You need to talk to your financial advisor. You need to know what your aspirations are. You need to talk to your accountant as well. But this is what happened to
Yeah.
me. So
Yeah.
coming back to your question, yes, if you do things right, the yield
Hmm.
will be, the productivity will be there. You can buy at places where rental yield is better, which is always better than the residential in commercial space.
Yeah.
And you can either sometime sublet, you can do some value adds where your rental yield can easily go up to 7-8%, even in Sydney.
Yeah.
So because I had an office where I partitioned it and rented it out to 3 different businesses, I was getting 8% rental yield from it.
So you
And that
design rental value out of it by doing the
exactly.
renovation.
And the
Yep.
same office, I sold it after 3.5 years, 40% more in value. So I made a 40% gain, as well as I was getting 8% rental return when at that time the commercial rates were at 3%.
Wow.
So what I'm saying is there are always pockets where you are able to get reasonable capital growth as well as
Yep.
rental yield. And if you're smart enough, you can add some value to it. So
Hmm.
you keep it for the longer period of time when you buy it at the right time and sell it at the right time. In most cases, you should be making money. But yes, and the previous question I forgot to answer a portion of that was the trust and syndicate learning.
Yes. Yes.
So commercial is definitely a best reason where people are able to pool their money together.
Yep.
Self-managed super fund is another way to pool people's money together. So I'm just
Hmm.
working on 2 deals. It's
Hmm.
12 friends.
Hmm.
12 friends. They all
Hmm.
had around 100 to $125,000 each. So
Yep.
they pooled money together in the super fund and they set up 2 SMSFs because you can have
Yep.
up to 6 people in each.
Yep.
So each super fund has over $800,000, and they're
Wow.
all IT working well. And now in last 3 months, they have already been able to secure 2 properties in each SMSF.
Yeah.
So imagine on their own, just having just
Mm.
over $100,000, they wouldn't even be able to set up an SMSF, let alone buy a property through it. So that's another way of syndicate, investment. Then yes, there are discretionary unit trust, other types of structures where we can
Yeah.
help you with the lending as well as where you can pool the money together, and now you can
Yeah.
go for something bigger, and
Yeah.
something bigger, especially in a maybe an off the plan or in a subdivision space. The returns could be amazingly well if it's executed the right way.
Thank you. I mean, these are very important examples because people who want to find inspiration, who have the risk appetite, who have the personal circumstances evaluated well with their accountants, financial planners, everyone,
Yes.
they need these inspirations for sure. I want to stay on the topic of commercials a little bit as well, in context of maximizing the borrowing capacity.
Yes.
So, borrowing capacity, because in today's market, when you're doing a buy and hold property, and it's very hard to have a positive geared sort of investment in residential space anyways, right?
Yes.
uh, Unless you start taking risk of probably buying apartments or townhouses. In Sydney, there are still good growth and rental returns in those sort of assets, but I'm talking Melbourne, a lot of other states as well.
Mm,
Generally, banks don't like the apartments and townhouses as much as they like bigger land plots, right? So,
mm.
so why? And as a lender, as a mortgage broker, what is the reason you think people have this so much fear about commercial? Because due diligence is due diligence. You do that in residential, you do that in commercial, as long as the things which are to be evaluated, they are evaluated, because commercial brings back the income to the family.
That's true. To be honest, I will put that down as first
Mm.
a lack of awareness.
Yep.
So people are a lot more educated when it comes to residential investments. And
Yep.
if you read articles on the websites or all the sources of information,
Mm.
predominantly they talk about residential. Uh,
Yes.
and most mortgage brokers, because imagine 74% of home loans are actually being managed and done by mortgage brokers, right?
That is a
So
staggering figure.
exactly. So that means, 3 out of 4 people, they will come to us for their loans. And sad to say that most mortgage brokers, they feel comfortable staying in within the residential space, because the
Yep.
residential space is very black and white. There's a lending policy, and if with the lending policy, if there are certain checks and balances, and if your client ticks all the checks and balances,
Yep.
that they will be approved for a certain amount of loans. It's very black and white, right?
Yep.
When it comes to commercial,
Yep.
there's nothing black and white. Uh,
Mm-hmm.
Same bank appetite can change depending on
Mm-hmm.
when at what time of the year you go to them,
Yep.
and there's a lot of subjective decisioning from the banks. So that's another reason, because there is a lot of a gray area.
Mm.
Brokers don't feel comfortable. So if
Yep.
they don't feel comfortable, they won't talk much about commercial with the clients, because at the end of
Mm.
the day, we are the ones who, in most cases, start the conversation.
Yep.
We open up with the ideas and the venues, and then it starts from there. So that's one main reason. We, being the source of information, we don't talk about commercial as much. Go
Mm.
online and search it up. You'll have core logic, you'll have real estate domain and all of that. You will not
Mm.
find a single well functioning commercial website that'll answer most of your questions. So that's another reason. The third reason is the complex part of it. The setup
Mm.
normally is a bit more complex.
Yep.
Most people will buy properties in their personal names.
Yep.
In commercial, in most cases, it has to be an entity. So that's where
Yep.
then you're okay. Or you have to go to a tax accountant. You might have to set up a company. There's an additional setup cost for it. Then you have to
Yep.
tax and audit every year. So there are a lot of complication required in that sense. Uh,
Yep.
I believe those are the reasons. And most people think that maybe buying commercial is a scheme for the bigger boys.
Yep.
You know,
So true.
yeah.
Absolutely.
So that all those reasons, obviously there will be more reasons as well. But yes, but it's changing. That we are doing our bit, and it's changing. And as you see,
Mm.
SMSF is also plays in a commercial space, and I see a lot of commercial
Mm.
purchase being done within a self-managed super fund space. So it is
Mm.
changing, not at a pace that you would like it, but we are getting there.
Yeah, and thank you for sharing again. It is very important that people understand how investors think, who have
Yep.
walked that path, who have got the returns, and how they've done it. Another thing from a borrowing capacity perspective is this incredible love of getting their first home as soon as possible, or going into the school zones which are uh, above the, like people are trying to punch above the weight sort of thing when they're trying
Yep.
to go to these expensive suburbs. And
Yes.
again, these are personal, meaningful, emotional reasons for people to do what they do, but that's exactly where they are compromising on their overall ability to invest as well,
Yep.
without knowing that they are really going into homes which they are not going to fully use, like a four-bedroom house, but they're still a single or a couple or a young family with only one child. And by the time the child will be 5, 6 years old, they actually don't need those big spaces, but they just
Mm.
want to enter because this is the FOMO, the peer pressure, the cultural aspects of a lot of communities where they want to have their home as early as possible. And I'm
Yeah.
seeing there's a shift coming through where we have served few of the clients in Sydney and Melbourne, young couples thinking of marrying, and they came to us in the expos where we had stalls, and they talked about rent vesting. And by taking the chances of continuing to live in the rental spaces, uh, they they optimize their ability to invest,
Yes.
uh, and they really got a good equity growth out of investments in areas like WA, Queensland, and South Australia, and they were very thankful. So you had some experience with this age group of young investors?
To be honest, again, it's the conventional wisdom. They're not trying to. They
Yeah.
still are stuck with that buying
Mm.
your home as the first home. That's why I
Yes.
always one line that I always use for the first home buyers, whether for the owner occupier or investor, when they have this
Yeah.
long list of wish list, and I said, please
Yeah.
just buy whatever you can because this is your first home, not the last home. So you would rather just keep your wish list
Mm.
and try to get there eventually, but do
Yeah.
whatever makes sense to you at this point in time. I believe one reason is yes, a lot of information is out there as a self-employed. Then the second
Mm.
is a first home buyers grants, because there
Mm.
is an intentional push from the government or the states as
Mm.
well for people to buy
Mm.
their own home. So people think maybe that will make a better financial outcome, have a better financial outcome for them if they somehow can make use of those, first home buyer benefits, even though
Yep.
they're not easy to get. Some of them are not easy. Like first homeowners grant is it's almost impossible for anyone to get because the
Mm.
thresholds are so lower. But
Yeah.
that's I believe is one. Again, it comes down to education bit. When they come
Mm.
to us,
Mm.
and even when they come to broker agents, buyers agents like yourself, if
Yep.
you are able to show them the other side of the story as
Mm.
well, that
Yep.
at the end of the day, if you are saving, getting growth more than what you will otherwise get if it was of your own house, having a
Mm.
property in a high growth area, for example, and then eventually either you use the equity from that growth or sell it and then help buy your own owner occupied property. If you make
Yep.
the right gestures and give them proper explanation, a lot of people would understand as well. But again, it's similar to having issues with commercial.
Mm.
It's a conventional lack of awareness, and we just
Mm.
gotta be just at it, continue trying it, and eventually more and more people will understand that.
So thank you for sharing your views, because there are some perceived fears as well that they will not get the benefits of buying their own home, which is only partially true, because
Yep.
there are always some duty waivers, etc. You will still get even if you become a first-time investor and become
Mm.
your home buyer later on. Uh, we still
Correct,
get
and it can
asked.
vary. It can vary with different states, and some state can still give you some sort of waivers, even if you're
Yes,
not a first-time buyer.
and SRO, people don't take the effort to call the SRO and just check it. It's that simple. Uh, um,
True.
so I think we are close to the end of this session. 5 minutes or so are remaining. What is the biggest uh, takeaway you want our viewers to take from today in terms of 2025 is here well and truly. We are
Yeah,
already 1 month in. We have 11 months to go. Especially people. Let's look at two type of people: the home buyers and investors. So if you can cover home buyers and then investors, what
sure.
are the key trends? What are the key things to focus on from a borrowing
Yeah.
perspective?
See,
As a
for
broker, what you
first-time
can say?
buyers, for example, I always, when I talk to them, is I ask them the first question: do you think you have a choice to live rent-free in Australia? If you do, never buy a house. But you know that no one lives rent-free. So if you are going to live with the rent, then the question is not that. Question is, do you want to pay off your own home or someone else's home?
Yep.
So that's why if you want someone else's home to be paid, then yeah, continue renting. But if not, buy your own house
Yep.
because that is a basic necessity. It's just the timing, you know.
Yep.
For the timing wise, first time buyers, to be honest, always the timing is right. If it's a necessity, then you got to have it. But more so in 2025 because there's a the supply side is pretty good at the moment still, and I
Yep.
read there have been more supply in January and more is expected in February. And there are
Yep.
a lot of bargains in places like Melbourne, in places like Sydney, even in the regional areas. Then you would tell more about Queensland and the other side. There's still bargains out there for investors. Uh, I believe you have a window of six months.
Yep.
In 6 months' time, you will start seeing the impact of the rate drops, and then
Yep.
you might end up buying the same property, maybe 25 to $50,000 more in dollar than you can now. So that's the question you need to make is, are you a investor who's looking to buy? If that is yes, then the timing should be, should I do it now or later? So the difference would be later you'll pay more, now you pay less. So it's very simple. And timing wise, I see it's good. Rates drop, which means the affordability goes up. Your
Yep.
monthly repayments also will come down relatively.
Yep.
Some reports that I've read is that once this rate drop cycle slows down, which could be maybe 2 years from now, we might be 1.5 to 2% lower than what the rates are now. So if that comes
Wow.
true, we should be looking at around somewhere around 4%, a bit more, and 4% a bit more. If you see, there will be one third of the current repayments going away from it. So I'm hoping that will relieve a lot of people who probably are finding it
Yep.
hard now to repay their loans, or who may think it will be
Yep.
hard for them to get a loan now versus sometimes from now. So good times are coming. That's what I say.
Absolutely. We are expecting a mini wave again in the next 12 to 18 months. And I mean, the as the famous quote says, the last time to buy a property was 20 years ago, and
Yeah,
the last best time was 20 years ago, and the next best time is today. So
true.
there is never, but I think it's a very personal circumstance thing as well. So an investor struggling with a borrowing capacity might be waiting for the loans interest rates to go down, and
True.
then, as you said, he might be able to free it up if they don't want to sell or they can't sell.
True.
And the investors who have the money, they are the ones I am surprised about, that they are also waiting for, because as you said, in good markets they are not the only ones who are jumping. The floodgates
True.
are opening, the stocks are coming through, and if you time it well, then you actually already are riding the growth rates, and then
True.
rather than waiting, you're not getting anything. Look, thank you so much, Sakib, for making the time today. It was very insightful. You're a profound professional. It comes across very clearly, and I'm sure a lot of people enjoyed it. So please,
Thank you.
all the viewers, this video will be posted back on our socials. Please drop your questions on your comments or whatever on the video as well,
Yep.
and we will make sure that Sakib answers them at some point. And of course, for all your financial needs, Secure Finance is there. Uh, they have been operating for so long. You can take a lot of benefit from their wisdom and services.
Sure. Thanks for giving me the opportunity, Puru, and I thoroughly enjoyed it. And I
Yep.
am available, so by all means, I'm happy to answer any question anyone would have. You can reach out. The name is there. And yeah, so again, I had a good time, and happy to do it again whenever we can.
We'll try to make sure that we get you onto this platform
Sure.
more often. Thank you so much.
No worries. You enjoy your night. Thanks a lot.
Thank you, everyone. Bye.
Thank you.